Let's look at Nigeria's case. I mean, Nigeria probably can be held up as one of those countries, if you like, that have prudently managed its debt profile, because now we're talking about in Nigeria with an external debt of just over $4 billion. How has this been done?
Thank you very much. Well, as you know, before 2005, 2006, we were faced with the challenge of an unsustainable external debt borrowing of nearly $36 billion. Over 30 billion of that was owed to the Paris Club group of creditor countries. Of course, thanks to the initiative of the administration and the rest of the team, we were able to negotiate for a 60% debt write-off, and we paid off the remaining $12 billion so that we were able to fully exit the $30 billion Paris Club debt. Of course, much after that, we also had to buy back our London Club debt and effected a substitution process for our promising notes. That brought down our external debt drastically down from $36 billion to less than $3.6 billion.
Right.
Now, of course, having done that, meaning that we had cleaned up the dirty portfolio, the burdensome portfolio, the odious portfolio, we now had to ask ourselves questions about what the normal course of public debt management is supposed to be. We recognized and we agreed that in as much as we had had a bad experience with accumulation of debt in the past, with little or nothing to show for it,
sure,
much of that debt arose from a capitalization of areas.
Yeah.
It was still important for us to assess the market, domestic and external, in such a way that we'll be able to mobilize resources to finance our huge infrastructure deficit,
right,
to generate growth, development, and poverty reduction.
Sure. So we now have that debt extremely low. Sorry, Doctor, but now we have that debt now extremely low at $4.3 billion. I think that's the figure that I've been given. What's the target now? We know debt is good if you use it in the appropriate areas. What's the target now? Where does Nigeria take it, and in which areas does it borrow to spend on?
Now, we have to look at it in context. What we have decided over this period is to use the opportunity of low external debt, knowing that we still had a little more space to borrow on a sustainable basis. We decided to use the opportunity to borrow from the domestic market, to use the opportunity to develop the domestic capital market, because before then, Nigeria's capital market was standing just on the equities leg, and we needed to develop the debt leg. So we decided to borrow from the domestic market so that in the process, we will not only be able to raise the required finances for government to fund its critical needs, but also so that we can develop the domestic market so that the private sector could access long-term funds for the development of the real sector of the economy.
Yeah.
And so in the process, we elongated the tenor, the dominant tenor of the public debt securities from 91 days to 20 years. As we know, we now have 5-year, 7-year, 10-year, and 20-year bonds in the market, which means we have developed the domestic bond market, particularly with the introduction of a fairly reliable secondary market in the sovereign bonds.
Yeah.
So that's what we have done. So the magic is that, yes, we have been borrowing, but we have focused on borrowing from domestic sources, not just to raise money, but to prepare the market so that the private sector could have access to long-term funds. Now, our total debt, external and domestic, as you said, is about $29 billion, about 4.3 external, and about 25 billion domestic. That still leaves us at about 16% of our gross domestic product.
Right.
As you well know, for countries in our peer group, the accepted threshold, debt GDP-wise, is about 40%. But in Nigeria, the government is being very cautious, and we are attempting to ensure that over the next 5 years up to 2014,
sure,
we do not exceed 25% of GDP, more or less. And the emphasis of government then is to try to see how we can develop other sources of funding the national priorities without accumulating debts, such as supporting public-private partnerships, such as providing guarantees for private sector infrastructure, and of course encouraging foreign direct investment.
Dr. Nwankwo, we have to leave there. Unfortunately, some would argue that perhaps that needs to be ramped up to another level, but perhaps that's a conversation for another day.